In this video, I would like to discuss fundamental analysis of stocks. As a stock investor, it's either you will adopt fundamental analysis or technical analysis. These are two very important strategies you could adopt to value stocks as an investor. Fundamental analysis of stocks involve evaluating companies' financial health and performance to determine precisely its intrinsic value and make informed investment decisions. And so here are key components and steps involved in fundamental analysis. Number one, financial statements analysis. That's the very first step you will adopt as a fundamental analyst. Number one is a financial statement analysis. So under this particular broad category, you look at number one, income statements. So you examine the company's revenue, you examine its expenses, you look into its profits and assess profitability and operational efficiency. You look at the income statement. Is there an increase in revenue? Is there a decrease in expenses? Is there an increase in profit level? How is the company utilizing its asset? Is it deploying its asset effectively to be able to generate results for the company? You look into all those things. Then you have balance sheet. So you review assets and liabilities. You equally review equity and evaluate financial stability and liquidity. Does the level of assets, is it more than the level of from liabilities? If it is more than liability, then of course the company has a strong balance sheet. How is the equity? The equity is the difference between the assets and the liability. So not only that, you ask yourself, what is the equity per share, of the company? So all these parameters are very, very important as a value investor. Then next is the cash flow statements. You analyze cash inflows as well as outflows to understand cash generation and how cash is being utilized in the company. Some companies may be profitable, but the profit is not reflected, as cash. You take that into consideration. Is the level of profit, does it reflect as cash? Does it generate cash? If it does, then that company is a strong company indeed. Number two is earning per share. Earning per share. So you calculate net income divided by the number of shares outstanding, indicating profitability on a per share basis. So you want to determine the company's earning per shares. You get the net income of the company, then you divide by the share outstanding. If the company's net income is $1 billion and the share outstanding is 1 billion shares, then of course your earning per share is going to be 1. So net income divided by shares outstanding gives you the earning per share, earning on the basis of the shares outstanding. Number 3 is price to earning ratio, the PE ratio. In this particular concept, you compare the stock price to its earning per share, helping to determine if the stock is overvalued or undervalued relative to its earnings. So how do you calculate price to earning ratios? You pick the company's current share price, all right, and then divide it by the earning per shares you've earlier obtained. And if the PE ratio is small, then the company is undervalued. And if the PE ratio is very high, the company might be overvalued. And of course, you do this in relation with other companies in the market or in the sector. So you should have an apple to apple comparison. That will give an idea of how cheap or how expensive the stock may be in relation to other stocks in the same sector or in the same industry. Number five is number four is price to book ratio. Price to book ratio. This compares the stock price to the company's book value per share, providing insight into how the market values the company's assets. So book value essentially is the net assets of the company. It's called the company's book value. And so you compare the the current price divided by the net assets per share. That will give you the price to book value of the company concerned. And of course, the lower, the better, the lower, the cheaper, the lower it shows that the company is undervalued. Number six, number five is dividend yield. Dividend yield. This parameter measures the annual dividend payment as a percentage of the stock price, indicating the income generated from dividends. In this case, if a company if the company share price is let's say $10, and then the company pays $1 out as dividends, the dividend yield there is 10% because $1 is 10% of $10. So the bigger the dividend yield, the better. It's telling you precisely how much what percentage of the company's stock price is being paid out as dividends. Number six is return on equity. Return on equity. It assesses how effectively the company uses shareholders' equity to generate profit. And of course, it's calculated as net income divided by what? By average shareholders' equity. You get the company's net income, all right, and you divide by the average shareholders' equity. Equity here means the difference between the company's assets and the company's liability. And so the greater the returns, the greater the value here, it indicates that the company actually is utilizing, shareholders' equity, effectively. It's bringing in better returns, more returns as it relates to the company's as it relates to the shareholders' equity in the company. Please like this video, subscribe to this channel, and don't forget to share. Number 8 is number 7 is debt to equity ratio. This particular ratio evaluates the company's financial leverage by comparing total debt to shareholder equity. You go to the balance sheet, you obtain the company's total value as debt, then divide that figure by the company's shareholder equity. That will give you the debt to equity ratio of the company. And so the lower the debt, the bigger the value of the debt to equity ratio, and the bigger the value, the better for the company fundamentally. And you have number 8 is a competitive position. You analyze the company's market share, competitive advantage, as well as industry position to assess its ability to maintain profitability. Can it be easily affected by a negative outcome in the market? Can it be easily affected by a competitor coming in to take market shares? And so how strong is the company's moat? How strong is its competitive advantages? You take all this into consideration as a fundamental investor. Number 9 is management quality. You evaluate the effectiveness and the track record of the management team, the leadership team, and the strategic, decision-making processes. Is the company's management, are they really aligned with shareholder value? Are they really aligned with shareholder interest? You ask all these questions. How effective are they? How trustworthy, how transparent, is the company's management? You equally look into this. This is an aspect of qualitative, investing. You look at the quality of management, the quality of earnings, and other related factors. Number 10, economic and industry conditions. You consider broader economic indicators and industry trends that might impact the company's performance and stock price. So, what are the current trends in the industry or in the sector that you think could impact the performance of the stock in that particular sector? For instance, now if there's an increase in oil price, national increase in oil price at an international level, that might impact, the airline industry because they rely, on fuel to a very great extent. And so the higher the fuel price, that will eat into their profits at the end of the day. So you tend to analyze, economic conditions and the industry conditions that might affect uh, the industry involved. If there's a general strike, maybe pilot strike or whatever, it might equally affect the performance of an airline. A circumstance like the pandemic, airlines were grounded, although it was a worldwide event that affected every other industry, but the airline were impacted to a disproportionately, higher degree. Number 11, growth prospects. You examine historical and projected revenue and earnings growth rates to gauge future potentials. Ask yourself, have the company been growing in the past 5, 10, 15 years? And if there's an increase in growth level year in, year out to the present year, all things being equal, the company will equally grow, in a similar pattern into the future. So you evaluate the company's growth prospect. Is the company stagnated? Is the company retrogressing when it comes to growth? You ask all these questions. And so whenever there's consistent growth, that company is a very good candidate, for your investments. Number 12, valuation models. Use various models like discount cash flow analysis to estimate the intrinsic value of the stock and compare it to the current price. By thoroughly analyzing these factors, investors can make more informed decisions, when buying, holding, or selling, stocks based on companies' overall financial health and market position. So personally, I do much of fundamental analysis. I don't do technical analysis actually. That particular concept is good for traders. If you are a trader, then technical analysis is the best candidate for you. But if you are a long-term buy and hold investor, then fundamental analysis of stock is something you should learn to do and be proficient in utilizing this particular concept to broaden your investment knowledge. That is it as far as this particular video is concerned. So be a fundamental analyst.